Welcome back. Let's return to the big story of the day. We are seeing a lot of banking and infrastructure finance companies like IDFC moving up because the RBI has come up with new norms for raising long-term loans funds which will be used to finance the affordable housing and infrastructure sector. To talk to us about these new norms, we are joined by Jaljit Bhattacharya, partner infrastructure and government services at KPMG. He's joining us in our Delhi studios. Mr. Bhattacharya, the good news is that for banks now they'll have a way of raising long-term funds to give finance to infrastructure and affordable housing. How much will this help match their asset and liabilities mismatch, which has risen quite a bit over the last couple of years?
Right. Let me just give you a size of what the problem is. If you look at the total share of real estate loans in the total loan portfolio in the economy, it's about 2 to 3.5%. Whereas globally it's around 30% for the advanced economies, which means that we are not giving enough credit to homeowners to own homes. And in spite of that, when the banks are trying to give that credit, they're ending up having a asset management liability mismatch because obviously their assets are short-term assets and they're trying to give loans for much longer-term infrastructure and low-cost housing that we are referring to. So it'll indeed go in a very long way to help them bring down that gap between the asset liability mismatch that they're having. So absolutely this will be extremely helpful.
Yes, what the RBI has come out with, that it has said that a motorization schedule of 80% of the concession period of the project. Now, most of these projects are really long-term projects, especially in the infrastructure sector, and a refinance option which is available every 5 to 7 years. How does this change the cost of funds for a borrower, say an infrastructure developer, and how much money will he have in his pocket if the repayment schedule is now easier?
Yeah, just keep in mind that along with it, what the RBI is also saying is that these funds will not have to have the criteria of SLR, CRR and priority sector lending, which itself brings on the cost of the funds. Now, along with it, when you're saying that you can have long-term borrowing, that implies that the cost of refinancing every time that you do that, which is that 5 by 25 kind of a principle. So if it's a 25-year-old loan, you keep refinancing it every 5 years. Every time you do the transaction, there is an added cost to it. And also there is a risk as to what interest rate you're going to get your assets in, because your liabilities are fixed. So what is it that at which rate will you get your assets in becomes a problematic question. Obviously you will do a risk hedging to that, which itself adds on to the cost. So the total cost balloons up if you look at all of this. And with this policy coming in, since you're taking with the cost of frequent refinancing and also the cost of adhering to the SLR, CRR and the priority sector lending, the total cost of fund comes down quite significantly.
Right, but this was about the banks, but let's talk about the NBFCs as well. Even they lend to infrastructure projects and all. What will happen to them? They are not supposed to maintain SLR, CRR, and also they don't have to really meet any priority sector lending norms. What is this guideline going to mean for an NBFC, or will this have any impact on them?
Definitely will have an impact because they're playing in the market. So the guidelines is more from an economic perspective. The economy needs, as I said, about $1 trillion of investment by 2017 in infrastructure. Where will it come from? If the banks don't give it and the NBFCs do not have enough ability to provide those funds, where will it come from? So this policy is more from an economic perspective. Obviously, the banks will become much more competitive and they're part of the formal economy. So are NBFCs now, which are part of the formal economy. So the NBFCs will now have to face the challenge from the banks in terms of the banks having a little advantage because of this norm coming in.
So are you trying to say that the banks will get more attractive, will become eventually more attractive for funding of these infra projects than the NBFCs?
So the NBFCs a priori did not have to bother about SLR, CRR and priority sector lending. So let's say they'll start having a level playing field now, because both of them will have the same kind of playing field. So the cost of funds will be similar and hence they will be at a level playing field.
Right, but we also want to understand that what happens to the already existing problem of stress, because these are for new loans raised. We don't have a lot of clarity on what happens to refinancing, because we spoke to the management at SBI and they indicated that refinancing happens at 50% of you get new bankers to refinance, and that may not happen very easily. over the long term, what happens to what we have left behind, because that's also a huge burden to carry.
That's always a problem. Grandfathering the existing assets which have been in a different regulatory framework will always be a challenge, and yes, that is a problem, and the devil lies in the details. There is no one answer to it. Each of the assets has to be looked on its own, and we have to work out a way to grandfather each of these assets.
And when it comes to affordable housing, some of the bankers also said that, for affordable housing, there's a lot of demand, and perhaps, the worries of stress may be lower because, the tenure is 7 years, and, it may repayments may start more quickly. Do you think this is going to be a big boost? What happens to the affordable housing sector? Because they are saying that, immediately we see a correction of 25 to 50 basis points in the cost of, the loans given there. Is that going to be a big game changer? It
will absolutely be. There is no doubt about it that there's a huge demand for low cost housing. On the last count, there is a gap of over 62 million housing requirement in this country. More importantly, what will happen is, because the cost of loans coming down, the ability to repay becomes that much more, and therefore the NPAs also come down. So it has benefits in two fashion. More people are able to access these funds, and they can have access to housing, which also has an implication on the economy per se, but also these people will be in a better position to repay the loans, and therefore the NPAs come down significantly. Hopefully this will trigger off a virtuous cycle, where because of this boom, there will be more people who will be able to earn more, and therefore be one of those who can buy these low cost housing.
But who will have the appetite for such bonds, for such long term infra bonds, according to you?
No, that's for the market to play out. There will be plenty of people who will have that appetite, because you're locking them in a certain
Do we see that
rate.
coming from the corporate sector?
It could come from the corporate sector. It could come from the financial institutions, because you're getting lucrative bonds, and at the end of the day, you're getting fixed at a rate for the next 7 years. And who knows, that the rate might be going down, or it might also go up. But the fact is that you're getting assured income, and that will be attractive for many of the sectors for sure.
All right, Mr. Bhattacharya, it was a pleasure talking to you. Thank you so much.
Thank you.
So there you had a view coming in from KPMG about the recent guidelines issued by RBI. And on this note, we'll slip into a very short break, but we will talk about this particular issue and many more, the macro data which has also come out today with Divakar Gupta of SBI, after a short break.